The 200 EMA is one of the most widely used exponential moving average of all, right? Traders use it all the time. Traders talk about it all the time. So in this video, I'm going to show you exactly how does it work, how do you use it, whether or not do we use it, but more importantly, does it work, right? So we did a test for the 200 EMA on stocks, Forex, and crypto. And in this video, we will give you our research and our verdict on whether or not should you use the 200 exponential moving average. Let's go. All right, so the 200 exponential moving average is something like this. If you look at the top over here, this is the 200 EMA line, and traders use it all the time to identify it as an overall trend direction, right? As a whole, the understanding of the 200 EMA is that if price is below the 200 EMA, price is overall in a downtrend, and if price is above the 200 EMA, it is in an uptrend. So we are going to run a test on this, right? Whether or not is this accurate? So let us show you some examples. So the next way that traders, before that, the next way that traders use is that they will use the 200 EMA as a rejection level. So every time it touches the 200 EMA, we will go for a sell. So for example, if price has closed below 200 EMA, the moment when it goes up and it touches the 200 EMA, we go for sell, we go for sell, we go for sell, we go for sell, right? And understanding that it is a pretty strong rejection level. So we have done our test to show you exactly or not does this method, does this strategy actually works. All right, so let's go. This is the 200 EMA. All right, and we place it on stock. So we use Apple as an example. So here we can see it's so beautiful, right? Price, the Apple is in an uptrend, right? The stock is in uptrend, and price has been above the 200 EMA for the longest time, right? So that is very nice. So if you use this as a gauge, you will know that, hey, if let's say price is above the 200 EMA, the stock is likely in an uptrend, and let's go for the buy, right? And then the moment when it crosses below, the stock is in the downtrend, then that's where you want to stop buying, and probably you want to close out the trade or the stock that you hold, right? And then that's where the stock tumbles down. So it does look good over here. Fantastic, brilliant, the typical chart that you would like to see all the time. And then what we do note is that as it goes along, there may be false breakouts. So for example, if you want to go for a buy over here, price, because the moment when price crosses above, you think there is an uptrend. The moment when if you want to play the rejection trade, you want to go for a buy over here. Price did a false breakout. You want to go for a buy over here. Price did a false breakout. And then here probably did work a little bit, right? And then when market goes up, the moment when it crosses below, you want to go for sell. Then you go for sell here. Maybe here's a zone, you go for sell here. You go for sell here, it didn't work. It went up, so it didn't work. And then it kind of got choppy over here, right? So then the moment when it came back down, right? You go for a sell here, it didn't work, it did a false breakout as a whole, right? And then here as a buy, it didn't work. Here probably as a zone, yes, it did work for the buy. This is Apple. Now in Bitcoin, we did a test on crypto as well. In an overall uptrend, it is pretty nice, as you can see, pretty nice as a whole, but not a lot of rejection at this area. Quite far away, there's some gaps. So the 200 EMA may not be ideal if you want to play a rejection. So you may need a closer EMA when price starts to separate out from the 200 EMA. That's where you want to have a closer EMA. Some traders use the 50 EMA. Some traders use the 100 EMA. It is for you to test. But this is something that we covered. What we are covering right now is the 200 EMA. So as a whole, it did work. But if you want to identify the trend has changed, probably not too ideal, because in this scenario, the gap went quite far. You need a closer one to identify where the trend is kind of changed from here, where it went downwards, right? So at this point, it really just ignored the 200 EMA. It just went up, down, up, down, up, down. So if you want to play the crossing, if you want to play the EMA, the buying and the selling and the rejection level, it never really work, right? Then we go for the euro dollar. The euro dollar, so all this we test on higher time frames, which makes the probability higher of it working. As you can see, rather choppy. Price didn't really touch 200 EMA. False breakout, right? Pretty much chop up and down. Here, it did work. Test. Breakthrough, it did work. This was kind of like a false breakout. Test. Pretty much work. Breakthrough, test. It worked. False breakout, didn't work. A little bit far away. At this point, not really. Right here, it's like really choppy. So as a whole, you do not know where's the exact direction because the 200 EMA is pretty much in the middle. After it kind of worked, test, it worked. Breakthrough, overall work. The gap was too far. Didn't really work, but overall, we can go for a sell downwards, right? Because you know that it's below 200 EMA. So that's all right. Here, choppy, didn't work. If you want to go for sell, didn't work. You likely got stop up, right? And then here is a really rather choppy, pretty much choppy. Here, overall, it went above 200 EMA, but no rejection level to go for buy. So the verdict is still that we need a shorter term moving average. Cross below, it acts as an indication to go for sell. Respect as a zone overall. Yeah. And then here choppy, and then overall as a zone again. So now the verdict. But before that, let us go for the EMA pros and the cons. EMA pros is that it acts as a strong dynamic support and resistance. This is about EMA in general. EMA Exponential Moving Average is something that I believe that traders should have in their charts because it acts as a strong dynamic and support, right? The cons is that they may have fake outs. As you can see at 200 EMA, there will be times whereby it touches, respects exactly. There will be times whereby it fakes through and then drops back down again. Fakes through and then drops back down. So there is fake out, right? You need to understand that this is part and parcel of the game. The next pros is that you have plenty of flexible settings. Like I told you, the 200 EMA is the bigger guideline. So you need a shorter one, right? So it's flexible. You can play the different multiple values, right? The cons is that the EMAs are subjective to pairings and settings. Different pair, this is an insight. Different pair respects different level as a whole, right? Some pairs in general, 200 pretty much respects, but some pair respect more, some pairs respect less. So you probably need to adjust the EMA levels a little bit. All right. The pros is that it is easy to identify a trend direction. So let's say it crosses above 200 EMA. Overall is an uptrend. The moment it crosses below, overall is a downtrend. So it's rather easy to identify in a simple way, right? If you want something clear cut, it is pretty direct. But there'll be times whereby it gets choppy. That's where you'll probably get lost whether or not is it an uptrend or downtrend. So then you probably need something else to tell you whether or not is it an uptrend or downtrend. So we did the analysis, three different kind of analysis. Number one is that we test for the average number of times a false breakout occurs before a complete change in trend. So what we did is we did a test of trend. So for example, the moment when price, let's say this is the 200 EMA, the moment when price closes above the 200 EMA, this is the start of the uptrend, right? So we test from the point of the uptrend to the point whereby it closes below, it goes down. From A to B, the point goes up and the point goes down. From this distance, we test for the number of times there is a false breakout. So it went deep below before going back up, deep below, number of times there are false breakouts, and the number of times there is actually the exact rejection at the line. All right. So this is something that we did a test for. So in the euro dollar, we tested it on a higher time frame, in a daily time frame, right? In one trend, the moment when it crosses above to the time whereby it breaks below, this is one trend, right? Because if you understand that as the saying goes in the general market is that if price breaks above the moving average, the 200 moving average, exponential moving average, generally it is an uptrend. So we wanted to test this fact, right? Whether or not is it true. So In the euro dollar, in one uptrend or downtrend, that means in one trend, from the time it closes above to the time it crosses below, or the time it crosses below to the time it crosses back up, in one trend, there are 4 forced breakouts, right? And 3 exact rejection. So which means that in a trend, there are 4 forced breakouts. And in that same trend, there are 3 exact rejection. And the average number of candles in that one trend, we did a test, is around 400, right? So in one trend, the period was rather long. So it is around 400 bars. So if it's the daily time frame, it's more than a year or so, right? So next, in Apple, the stock, in an uptrend, there is around 1.29 forced breakout and also just 1 exact rejection. In crypto, in Bitcoin, the forced breakout is 0.73, right? The exact rejection is 1.64. So if you look at this overall, crypto, right? Price respects the 200 EMA more. In terms of exact rejection, there's lesser number of forced rejection. So if you want to use this to the dot, the 200 EMA to the dot, whereby every time it forms a trend, you want to place a buy or a sell when it exact respecting, crypto works the best because the exact rejection is more than the forced breakout. Forex didn't work that well because the exact rejection is 3, the forced breakout is 4. So the exact rejection is lesser than the forced breakout. Unless you have a way to identify that it is a forced breakout by using this as a flat way of purely entering every time it touches the EMA, is not going to work, right? So you need more factors, for example, price action or something else, to clearly identify that it is a strong rejection level. It is likely going to be a strong rejection level. That's where you want to go for a buy or a sell, right? So that you will avoid the forced breakout. For stock, it's probably around the same number of rejection to the same number of breakouts, right? The length of period in one trend, Forex for euro dollar is 400, which is a lot, which means that price, generally when price do an official break, it is big. It is a big one. So the 200 EMA as a whole, price respects 200 EMA as a whole in terms of the trend, whether is it uptrend or downtrend, because it is a rather big gap. And stock is Apple is also 400 over, crypto 250, 246, but overall still a pretty decent number of bars, right? So our verdict is that the 200 EMA has a poor rejection to forced breakout ratio if you want to use it to the dot, right? However, it is able to identify trends for a significant period because the number of trends, the number of bars is quite big, as you can see, 400 over bars, right? So which means that you can use the 200 EMA as a guideline, I not say exactly as a guideline to identify whether it's an uptrend or a downtrend, as a guideline. But there will be times where a price is too far away from the 200 EMA, you will need a closer EMA, probably the 50, probably 100 or something else, right? All right. So ultimately, the testing results vary from pairing to pairing based on individual characteristics of the pair, as well as the setting of the EMA itself. So the 200 EMA itself as a whole, if you wanted to use it to the dot, we rate it the 4 out of 10, right? If you want to use it to the dot. EMA as a whole is a good indicator, but you cannot use it exactly to the dot. You need to combine it with other factors to prevent the forced breakout, because as based on our stats, the forced breakouts is more likely higher than the exact number of exact rejection. So if you're going to use it to the dot, you're going to lose more than you win. So unless you have a proper system whereby if you lose less. If you win, you win more, meaning your risk ratio got to be good. That's where it becomes profitable, right? Other than that, EMA is usable. 200 EMA, if you want to use it to the dot, we probably rate it a 4 out of 10. So I hope you like this video of what we do over here at Asia Forex Mentor. This is what we're trying to do. We will cover all these single indicators, patterns, strategies, and then we will analyze them. We will analyze them on the Forex, stocks, crypto. We do our back test and everything. And then we give you our verdict on how should you use it and whether or not as a whole does it work actually. Right, so if you like this video, give it a thumbs up. Right, do follow, subscribe us for more weekly videos, and leave a comment below to let me know what you think. All right, with that said, I'll see you on next video.